So first to calculate and construct TD-VAR, for a location S, on the top over there, we calculate at the average temperature from 1960 to 2005 and subtract that from a temperature today for a location S. So this could be at a state or it could be at a country level if you wanted to. And then we calculate TD tilde. This is the average temperature anomaly for a single month for a location. And then once we calculate the standard deviation, this is what we're interested in the bottom, TD-VAR. This is the change in the variability across time from 1960 to 2005 from today, what's occurring today. So we're looking at the shifts in this variability across time. And that's what we say is the most important aspect of what's causing disruptions in firms. And so first we look at and estimate the exposure of firms by regressing firm returns on TD-VAR and TD that have experienced these shocks to temperature at their firm level headquarters. So we regress them on TD and TD-VAR as well as a set of control variables. And across all industries, we find that there's no real aggregate effect. And this is backed up by other prior research done by Adum, for example. But what we do find is that once we look at the more granular aspects of certain industries, an increase in TD tilde, this is the left-hand side graphs we were talking about, as that increases, there's actually a negative asset returns for utility companies. So how we describe this is that as the shifts in temperature increase, utility companies have to build more infrastructure to be able to meet demands and consumer demands for increased electricity. And however, for TD-VAR, this is much more of an acute shock that occurs in a certain period of time. So when that occurs, consumer demand increases, therefore increasing the profitability as well as the cash flows of the utility company. And then as well as we find that as TD-VAR increases, the returns for consumer discretionary and staples as well as the energy sectors decrease with it. So that's more of a consumer demand channel, as that people will go out, buy less things. The energy sector, it's more difficult to work during more extreme climate temperatures. That's why we see this relationship. But we try to dig into this a bit more. So we look at the reaction. We construct a spatial portfolio strategy to see whether investors are really reacting to and are attentive towards these temperature metrics. So what we do is sort states into quintiles based on their TD tilde or TD-VAR exposure. So if you can see in the graph here, we would sort them into quintiles. So the top 10 states, you can see the Midwest, for example, these are highly exposed states. So the firms that are headquartered in those exposed states will be put into quintile 5. So these are highly exposed firms that have been done at the monthly frequency. And then the Southeast would be put into quintile 1. These are least exposed. The firms in these states would be least exposed. So we try to see how these returns, when we market adjust them using the Fromm-French factors as well as the momentum factor, how do abnormal returns for these firms that are more affected to TD tilde or TD-VAR, how do they respond? So what we find here is that in the column, the 4-factor column, we find positive abnormal returns. So what this is saying is that for quintile 1, these are the least exposed firms. They're actually experiencing greater abnormal returns if they're less exposed, right? So comparatively, we find very low abnormal returns for firms that are headquartered in states that have experienced high levels of these temperature anomalies. Or sorry, the changes in the variability of temperature anomalies. So what we try to do is then, once we have these two results, we try to attribute them to whether they're coming from cash flows, investor attention, and other variables that could be occurring. What could be occurring here? So here, abnormal returns, they could be looking at attention, expectations. Analysts could be attentive towards these climate shocks and firms that are exposed, because there's been plenty of research done that says that if there's a heat wave outside, investors will react towards that heat wave and price in climate change more frequently. But there's the real business impact. So the actual operational footprint of the firm might be affected as well. So what we try to do is try to see and divorce these two issues and see which one is actually kind of the leading issue here. What's causing the real abnormal returns that we're seeing? So Sautner developed a frequency of climate change exposure that's developed in the earnings for conference calls. So they basically say that during these conference calls, analysts will bring up climate change issues, climate change exposure, when analysts talk about it, when it's particularly salient for them to do so. And so Choi also, they provide evidence that as I said earlier, as there's increased temperature variability, heat waves, these will shift attention towards this. So what we do is try to regress climate change exposure from Saltner's index on the temperature metrics while we control for attention. So we're trying to control for aggregate global attention and see if there's actually anything that's extra coming from TD and TD-VAR. And so what we find is that for TD-VAR, there's a positive relationship for the number of times they mention climate change exposure for all industries and for utility companies. And then finally, we look at cash flow and discount rate news. So we use the methodology developed in accounting literature as well as finance literature that decomposes returns based on into cash flow and discount rate news. And so we then regress these returns on temperature metrics while, again, controlling for attention. So what we find is that, similar to our very first results that we presented, is that TD-VAR, as that increases, there's a negative relationship between consumer discretionary and staples. So again, this is the consumer demand channel. People are potentially buying less goods when these large heat waves, there's for example, a shock in Texas, while there's a positive relationship for utility companies. Again, when there's higher demand from consumers for more electricity, when during a hotter day, that will increase their profitability, their cash flows. And so to conclude, what we do is TD-VAR really it allows us to isolate the true effect of temperature. And what we find is that TD-VAR is a financially relevant metric for specific industries, which hasn't been found in the literature before this. So what we try to attribute this is that the effect of TD-VAR, this variability, this changes in variability, goes beyond attention and is observable on fundamentals, which is cash flows. And so what we say is that for policy recommendations, TD-VAR can be replicated across all geographies and across all time periods as well. And so it can serve as a financially relevant metric to quantify and really report physical climate change exposure for firms. And that's what we would like to do. That is my presentation. I have a bunch of other things we could look at, but I'm open to questions. Thank you very much. Yes, please.
Hi. So you're controlling for attention, but are you controlling for multi-jurisdictional companies? So you're talking about consumer staples. First one that comes to mind is Walmart. Their headquarters is Bentonville, Arkansas, but that's not where they're making their money.
Right. So what we actually try to do is, so I didn't get into this because it was a short presentation, but what we try to do, so we've had this issue of, is their headquarter really their headquarter, right? So what we try to do is look at the 10K filings, and we see the number of times they mention their headquarter versus other states in the 10Ks. So if they mention, for example, a bunch of other states, then we remove those firms that mention a wider geography versus ones that mention their headquarters state more often. So we kind of just separate that sample, and we find stronger results or similar results. I think that answers your question. Exactly, yeah. So it does fall into a little bit of a size issue there, but we do find that this effect stays and is stronger for these firms. Yes, go ahead.
Oh, and for folks in the audience, if you could just say your name and where you're from, that would be great.
Sure. Thank you very much. My name is Scott Kalb. I'm with the Responsible Asset Allocator Initiative. So could you go back to the slide that showed the map of the states that you had, which were highly exposed and less exposed?
These ones.
Right. So it looks like you here, the less exposed state, I wonder how you came up with this metric. For example, Florida or some of those southeastern states are actually exposed to climate-related weather changes. And so it looks like you're just focusing on those that are affected by heat directly, but what about the indirect impacts, right? So we know we've got weather-related events like hurricanes and other things which have had a dire impact. So how do you factor in that? And the second thing is that in many cases, when the costs related to climate are externalized, the companies can actually avoid bearing the cost and it gets picked up by, taxpayers or whatever, or society. And so your numbers can be distorted by those externalities. A company would be, if there's a big impact, they would be motivated in a way to just externalize that cost if they can, rather than bearing it on their own income statement and balance sheet. So those two questions, please.
Sure. Thank you for your question. Very interesting question. So here, so this would be is an example. So this is at a yearly frequency, for example, but this would be changing constantly across at a monthly frequency, for example. So this would just be a snapshot of the most exposed headquarters of firms and states at a certain period of time. So your question was looking at hurricane risk. We're not trying to measure hurricane risk. Obviously, that's a very important physical climate risk exposure, right? But temperature, we believe, has been studied quite heavily, and it's one of the most direct forms of climate change that will be occurring because of global warming, and emissions of carbon. So that's why we're focusing on temperature. Obviously, there's other physical risks. We're just not. This is not the point of this paper specifically. And for your second question, the costs are externalized. So yes, for example, in Florida, the government will perhaps build pumps to bring out water, which will be protecting companies or firms that are headquartered in those states, right? So for TD VAR here, it's a very acute shock. So this is occurring. This variability is changing across space. So it would occur fairly at short frequencies, so short intervals. So it's very difficult for I would say, for governments and policymakers to actually help companies for these short periods of time. Remember for Texas, for example, when that large cold wave hit, basically all the utility companies shut down. So it's very difficult for them to, in that short period of time, to actually help those firms. So the supply chains were really disrupted even for months afterwards, after that shock hit. So maybe after that adaptation, that could change. But we see this shift across, from the first graph, the shift across time as well. So increasing extremes that are occurring. So we believe this is more of an acute type of shock. And so sea level rise, the other things, I think there are more effective at governments to subsidize, and protect firms, for example. Thank you for your question.
I wanted to thank you so much for that, your very robust answer and excellent questions from the audience. Just in the interest of making sure that all of our panelists can present, if you have a question for Atreya, can you hold it to the end? And Fei, love for you to move on to your presentation on climate laws and cross-border mergers and acquisitions.
Thank you, Tracy.
You're welcome.
Well, first, I would like to thank the conference organizers for including the paper in the program, and my co-authors who are at the University of Hong Kong. And I have been working on this paper for a number of months now, but we still feel that it's at a stage that can benefit from the comments from a wide range of audiences. So I'm really look forward to your feedback. As Tracy introduced, this is a paper that's about climate laws and cross-borders and acquisitions. And the idea is actually very simple. We're looking at how the climate laws enactment in a country will impact the intensity of cross-border merger acquisitions received by firms located in that country. And to motivate the paper, I think I'm going to make one of the least controversial statements that will be ever made in this room. That is, I think climate change is one of the most pressing challenges that we're going to face in our lifetime. And in response to this pressing challenge, countries around the world have been increasingly adopting climate-related laws and regulations. And these laws and regulations are national level legislations or executive orders that aim at improving climate risk mitigation or adaptation. They're also trying to put a stop to regulatory arbitrage, to carbon leakage, through which multinational corporations are moving their most pollutive assets to countries without stringent climate rules or regulations. And some specific policy goals that we look at in our paper include the usual suspects: reducing energy usage, lower carbon emission, and promote research and promote climate-related research and development efforts, as well as introduce the carbon pricing. And hearing to the slew of climate laws and regulations that have been passed around the country, so there was a recent survey by two financial economists at NYU, and one of the punchline findings of the survey is that businesses and business executives, investors, they view regulatory risk as the most important climate-related risk in the next 5 years. So that's why we want to focus on the regulation related to climate. And then we're not the first paper, we're not the first investigation to look at how corporate decision makings are going to be impacted by climate policies. There are a number of studies that have shown that these policies have impacted the capital structure decisions, impacted the location of firms' carbon emission, as well as R&D efforts by firms. The reason we focus on cross-border merger acquisitions in our investigation is of twofold. One is the sheer economic significance of cross-border merger acquisitions. On average, cross-border acquisitions represent about 40% of the total global M&A volume. And then in terms of dollar value, in 2019 alone, cross-border acquisitions amount to a total of $1.2 trillion. And then in addition to the sheer economic importance of cross-border merger acquisitions, and these global transactions have also been shown to confer beneficial effects to firms in the target country. For example, has been documented that cross-border acquisitions can facilitate international flow and improve corporate governance, improve operating efficiency of targets in countries receiving these cross-border acquisitions. All right? And we developed two competing hypotheses regarding how climate laws will impact the intensity of cross-border merger acquisitions that a country will receive as a result. And the first part of the hypothesis is that we believe there's going to be a chilling effect from the climate laws on the cross-border merger acquisitions received by a country that passes these laws. And there are at least three reasons for that. One is that, as with any regulation, climate regulations will impose restrictions and costs to the operation and restructuring and post-merger operation of the combined entity. As a result, this is going to have a potential negative effect on the expected synergy and make it more difficult to realize the expected synergy. And then the second reason why this could be the case is that as one of the major motives behind the introduction of these climate laws is to stop regulatory arbitrage, stop carbon leakage. So climate law regulations can deter certain acquirers from dumping most pollutive assets to countries without climate law regulation. And third possible reason for the chilling effect is that as with any regulation with additional costs and restrictions, a lot of the inefficient firms that previously operate in the target country may be driven out of the industry or may be consolidated, and the remaining firm will become more efficient, and this will reduce the potential supply of attractive targets for the cross-border acquirers. But at the same time, there's also reason to expect that a climate law may have a positive effect on the cross-border acquisitions that a firm will receive. Again, we developed three reasons for that. One is related to the policy uncertainty that's being resolved by the passage of climate law regulations by a country. And there's a well-established literature, and there's also theory showing that firms tend to delay their investment when they are unsure about the direction of a country's policy making. And the argument here is that by the passage of climate laws, a lot of that uncertainty will be, or some degree of that uncertainty will be resolved, which will encourage firms that have been on the sideline to actually go ahead with their cross-border acquisition attempts. And then the second reason for the potential positive effect is that as a result of the climate law regulations, firms in the target country may develop higher resiliency to the physical risk imposed by climate risk, and this may make firms in these countries more attractive to cross-border acquirers, again, resulting in a potential positive effect, uptick in the cross-border transactions received by these countries. And then lastly, related to the carbon emission reduction and energy transition mandated by a lot of the climate law regulations, acquirers from countries with developed green technology with more efficient production technology may see opportunity to transfer their technology to target countries that are in need of such technology. So that's another reason that the effect of climate laws may be positive on cross-border transactions. And we also developed 2 additional hypotheses related to exactly what kind of industry, if there's any effect related to climate laws on cross-border deals, are all firms going to be impacted the same way? And our hypothesis here is that we expect to see a more pronounced effect of climate laws on cross-border acquisition deals when targets are operating in industries that are most susceptible, most exposed to climate laws. And then with any laws and regulations, I think the degree to which a country can effectively enforce these laws and country should be important. So we expect to see a more pronounced effect in countries that can more effectively enforce climate law regulations. And then to test these hypotheses, we gather a rather comprehensive database of climate laws and regulations passed by countries around the world. So I'm not going to bore you with the details, but just a quick one sentence description of the landscape. At this point, about 158 or 160 countries around the world have passed some form of climate law regulations. Of course, these happen at different points. These happen at different points in time. Before 2000, only 20 countries have passed such laws, and then between 2000 and 2010, about 70 countries, and then since 2010, about 60-something countries passed laws and regulations. And we gather a large database of cross-border acquisitions over a 35-year period to test our hypothesis. And this is the baseline result that I would like to show you. So the dependent variable is the number of cross-border takeover attempts received by firms in country I from acquirers located in country J in a particular year T. And then the key independent variable that I would like to bring your attention to is climate law passed by the target country. That's an indicator representing whether the target country has passed a major climate law or regulation in the past. And as you can see from the coefficient, which is significantly negative, what that indicates is that in countries that have passed major climate law regulations, the number of cross-border acquisitions it's going to receive will be significantly lower. So that's consistent with the chilling effect of climate law regulations on cross-border transactions. And then we use a different specification where we use a climate law stringency index that's available for the OECD countries. We find the same results. Basically, the more stringent the climate law regulation in a country is, the more significant is the negative effect of such laws on the number of cross-border acquisitions received by target firms in these countries. And we have a lot of additional results that I'm not going to go over. And then to bring out more granularity within our general pattern, we run our analysis separately for cross-border transactions targeting firms in different industries. And our hypothesis is that for firms, for transactions involving targeting industries that are more exposed to climate regulations, we expect to see a more pronounced effect. What are these industries? Mining, manufacturing, gas and oil exploration, and transportation. And exactly as we predict, the chilling effect of climate laws on cross-border transactions actually is concentrated in industries that are going to be most impacted by such laws and regulations. And we also test the strength of legal enforcement and how in the target country to see how that's impacting the relation between climate laws and cross-border transactions. Again, we find that the stronger the legal enforcement regime in the target country, the more pronounced the chilling effect of climate laws and regulations on the cross-border transactions. And of course, one thing that you may be wondering is that do all acquirers respond the same way to target countries that have passed climate law regulations? And the answer is no. So here we try to bring out some heterogeneity among acquirer countries. And the idea here is that if acquirers are coming from countries that have high concern for climate risk or that have experienced climate-related disasters in the past, our hypothesis is that these acquirers may view climate regulations and climate laws as necessary evil that they have to comply with, they have to tolerate in operating a business. So they're not going to be as turned off or deterred by the target country's climate law regulation, and that's precisely what we find. And then lastly, in relation to the law, the extent to which the law will be enforced differentially across different countries, we find that when a target country passes a climate law regulation, it's likely to enforce such laws more stringently if the acquirers come from countries that are less politically aligned with the target country. So there's a selective enforcement component going on here. And to give you some more evidence on the wealth impact or on the direct impact of climate law regulations on potential deal outcomes that we observe, including whether a deal is more likely to be completed and the wealth effects associated with transactions, what we find is that the passage of climate law regulations in the target country will significantly increase the probability that a previously announced deal now will be withdrawn. So indicating that the corporate managers indeed respond pretty quickly to the climate regulatory environment in the target country. And consistent with the hypothesis that these climate law regulations will impose frictions and costs on the potential synergistic gains that can be realized from a proposed transaction, we find that the total deal synergy of a completed transaction is lower in countries that have passed the law in climate. And we also find that takeover premium that acquirers are willing to offer is lower, as well as the improvement in operating performance from before to after the transaction. That's also going to be lower in countries with climate law regulations.
So, Fei, I just wanted to know how much more do you have?
This is the last slide.
All right.
This is the last slide. So to conclude, so what we find is that the passage of climate law regulations reduce cross-border acquisitions received by firms in the law-passing country, and these laws have a direct impact on the outcomes of these deals, on the wealth effects of these deals. And the implications here are of twofold. One is that, obviously climate laws, based on our evidence, have been shown to affect capital, international capital flow. And what I would also like to make a connection to potential unintended consequences of these climate law regulations, especially given the documented benefits associated with international merger acquisitions in the past. Okay, thank you so much.
Thank you so much for that, Fei. And now we will open the floor for questions. And just remember to give us your name and where you're from.
Can I start with a quick question?
Sure.
Georg, hi. And in continuation of the discussion last evening, just a quick question. Have you broken down the type of mergers and acquisitions too? I mean, have you made an attempt to distinguish, say, green versus brown? It would be interesting whether the finding would be different. And secondly, another fundamental issue seems to be energy prices in absolute terms, costs of production, which may overshadow as well. But my first point would be more curious about. Thank you.
We actually thought about, thanks so much for the great question. We actually thought about the first question because we think that for acquisitions that are driven by green innovation or green technology, we may see an uptick in response to the climate law regulations. So we looked at the patent filings and by acquirers and the targets, and as well as the patent filings by the acquirer and target industry, and we still couldn't find a positive effect from those subsamples. And then the second question, that is the specifics of the carbon pricing or carbon tax. We have not, been able to go into that much specifics in our investigation. And one of the things that we plan to do is to maybe isolate our attention on climate law regulations that specifically introduce carbon pricing or carbon tax to see, whether the results will be stronger there. But it's a very well thought question. Go ahead.
Hi, thank you. Alex Clark, Oxford University. I think you partially answered my question just now, But I was going to ask, whether you've looked into some of the specific cases or case studies to try and understand the dynamics of what actually happened during the course of an acquisition. It seems like that hasn't been the focus of the research, which, congratulations, by the way, it's fascinating. But I wonder, taking this forward, either within your own discipline or with researchers from other disciplines, might it make sense to start looking at some of the deals in question in much more forensic detail to try and understand what exactly is driving each of these cases in a sort of case study approach, and how do you think that would complement the quantitative work you've done here?
Well, thank you. That's another issue. That's another thing that we have thought about, especially in the deal with the jaw analysis. And because for that analysis, we look at the deals that were announced within a year before the passage of takeover climate laws in the targeted country, and we track the completion or withdrawal status of that deal. And we could look into some of these deals, and especially the announcement that they make when they withdraw such previously announced transaction, to see whether climate regulation is something they mentioned. We have thought about it, but we haven't done that yet.
Thank you so much. My name is Leo. I'm from Columbia University, and I'm studying sustainability management there. I have two questions, one a little bit more technical and the other one a bit more, let's say, broad. The technical question is, how did you measure political similarity between different countries? And the second one is, now, given your research, could you give a little bit of flavor about how a possible carbon border adjustment mechanism in Europe might affect capital flows and M&As?
Great questions. And first of all, the way we measure the political alignment of two countries is based on the similarity of their representatives' vote at the United Nations meetings. So that's response to your first question. And the second question is, I think you'll be my intuition and hunch is probably the same as yours about the carbon the carbon tracking across borders, because that would I would say go a long way in stopping a lot of the carbon leakage and regulatory arbitrage that we have seen driving some of the cross-border merger acquisitions. And my prediction is that after Europe put that measure into place, that's probably going to reduce some of the significance that we find for the targeted country climate law regulatory framework.
Thank you, everybody, for your questions. If you have more, on hold, because I want to make sure that Stefan can give his presentation on ESG home bias.
Thank you.
Awesome. Oh, no, you were great.
All right, I'm going to try to stand here so I don't risk falling off the stage. Thank you so much for having me. This is work on the ESG home bias. It's joined with Mochi in London. And really, the starting point for this project was the observation that there is massive and still increasing investment in ESG. So you can look at the statistics yourselves. Essentially, one of the observations was that basically, there is now a lot of investment in ESG, but investors are not always in the location where they invest. And so, some of the stats are listed here. Shareholders are getting increasingly interested. They are getting increasingly active in ESG decisions at the firm level. Many ESG funds out there. And some of these ESG funds have actually started just shunning actively locally offending firms. Now, one of the side effects that's documented out there is that firms respond to this. Firms would essentially start by exporting pollution. And this has been going on for years, and it's also one of the things that has been increasing over years. So there is some data on this. Basically, firms 7 years ago emitted 43% of their global emissions abroad. This used to be 28% in 2008. Getting more up-to-date data on this is hard, but it's probably above 50% now. And so, where we come in is kind of this idea that some of the costs must be borne by some countries, the countries where pollution is exported to. So really, here we want to ask whether investors, with all of their ESG interest, actually understand that this is going on, and whether they care, and whether it matters where these investors are located. So what we're going to do in this project is basically study the stock price response to ESG incidents. So think about pollution. as a function of whether this pollution happens at home, in the headquarter country of the company, or whether it happens abroad. All right, so here's an example. There might be some Norwegian company and it's involved in some environmental scandal. And so this scandal might be in Norway, or it might be a very similar, very comparable scandal in Brazil. And it might be caused by the same Norwegian firm. Now our question is going to be whether the stock market responds similarly to these two events, or whether it's able to distinguish between events that happen at home, in Norway in this case, or in Brazil. Now, this response, it could be similar if the cash flow implications are exactly the same, okay? If the punishment is the same, if reputation costs are the same, and so on. The response could also be very similar when there is no difference in investor preferences. Now, we don't do this on just these two events that I just made up, but we actually do it across 7,000 ESG incidents around the world, involving 6,000 public firms and 76 countries. And so basically we're going to run an event study that compares the returns for events that happen at home versus those abroad. Let me try to dive a little bit deeper into what exactly is going on with these foreign incident returns. Before I get cut off for going over time, the key takeaway really is, I mean, investors respond to these ESG incidents the way we think they should. So all of these incidents, they come with negative stock returns on average. This translates into a loss in value of roughly $14 million US dollars per event. When we compare the foreign events to the domestic events, it turns out that the returns are less negative to foreign events. So think of the Norwegian firm violating some environmental law in Brazil. These events are punished less by investors. When we dive into what drives these results, we find that for one thing, the location of investors actually matters. If that Norwegian company has Brazilian investors, returns will be negative. If that Norwegian company does not have Brazilian investors, the response will be much less negative, if not even zero. So investor origin seems to matter. We also dive a little bit into preferences, and so it turns out when firms are headquartered in countries with strong preferences in favor of environmental standards, then these foreign returns will actually be negative, okay? So when people care about the environment, then foreign events matter more. Similarly for patriotism, so here the more patriotistic a country is, turns out the less they care about foreign events. There are some gravity models out there, and most of the inputs of these models do not seem to pick up, do not seem to be able to distinguish between the returns. Trade relations matter a little bit. And of course, geographic exposure matters. So when you have a subsidiary in Brazil, then your returns might as well be negative. And so the takeaway really is that preferences and investor location actually matter in valuing ESG, okay? So it turns out that exported pollution, is, only to name one example, is punished less, which may have consequences for the countries that attract this pollution. All right, so I want to talk just a little bit about the data. So the data is essentially based on RepRisk's collection of tens of thousands of ESG incidents. They do all the work for us, basically. They even link these incidents to public and private firms. Okay, so they figure out location, severity, media coverage, and which companies are involved. So here's one example. I don't need to tell you that this is likely an environmental incident. It's happening in Brazil, and it involves, most importantly for us, at the bottom right, it involves a couple of companies. One of them is, I believe, a Norwegian company. The others are Brazilian companies. And so basically we can test within this event which shareholders punish these firms more. But also Norsk Hydro might show up in other events where they pollute at home or elsewhere in the world. And so we're going to also make use of that. This is probably not readable, but this is the list of incidents this company actually considers. So we will see things like child labor, tax evasion, and so on. All right, so I want to give a brief outline of the results. And so here is really just our baseline result. This is really just showing that incidents come with negative returns. So your left-hand side variable is going to be returns, abnormal returns in this case, at the monthly level for all of these companies. And on your right-hand side, you're going to see many, many controls, mostly fixed effects that hopefully take care of many things. And then most importantly, a dummy that switches on the month one of these incidents happens. And so it turns out these incidents come with negative returns of roughly 0.6%. When we split up these returns into events that happen at home and abroad, it's the events at home that come with more negative returns, also roughly negative 0.6%. Foreign events come with roughly 3.5%, and that's significantly different. All right, so then we dive into the channels. So basically, what drives these negative returns, especially on foreign events? Is there any variation in these negative foreign event returns? So the first thing, and I mentioned this earlier, is we look at ownership. Where are the investors actually located? And so you can think of Brazilian owners of a non-Brazilian company that is polluting in Brazil. Well, this turns out to be incidents that actually matter. Okay? So one role might be played here by attention to these events, of course. All right, so there's that. We dive into two other channels. One of them has to do with environmental preferences in companies' home country. So think of countries where people are simply, more willing to act and to pay on behalf of the environment. Turns out, in countries like this, these foreign events, they actually matter. So Canada is an example of this. It will actually show up highly on this kind of measure. And their foreign events even matter more than domestic events. And not so much in the US, okay? In the US, it actually turns out that domestic events are come with a more negative return. All right. And so here's just an example of the type of analysis we run now. So we're going to throw in a bunch more controls. Most importantly, we're going to control for ownership. So like these Brazilian owners of the Norwegian firm that respond very strongly when the Norwegian company pollutes the environment in Brazil. All right. So very brief summary of the results. We run an event study around 7,000 incidents, around 6,000 companies. We show that these events, these incidents, these negative ESG incidents are associated with negative stock price responses. What drives the foreign returns are investor origin, environmental preferences, and patriotism. Now, my other research is on the dark side of finance, and this project was actually an attempt to get out of this niche of research. It turns out that probably didn't work as intended. I mean, you judge for yourself. But there seems to be a darker view on ESG investment here, and it's the view that investor location actually matters. When someone pollutes in front of your home, in front of your front door, you're going to punish that heavily. When it happens far, far away, it matters less. That's all I have. So yeah, thank you very much. I look forward to the questions.
And don't forget your name and where you're from. I'm doing really well at saying this.
Thank you. Thank you for the wonderful presentation. So I'm Simon Xu from UC Berkeley. I'm just wondering if you have a view on kind of like, there's a whole recent literature on like ESG disagreement, right? So, exporting pollution is a pretty clear-cut negative, image. But, what would you say about, kind of ESG scores across different vendors, kind of having very little correlation with each other? I mean, Repress is one of them, but, there's a lot of other providers. So if you could shed some light on that.
Yeah, so I think where this really matters here is whether all our 7,000 events are really universally agreed upon as negative events. And so we thought about this for a little bit. On environmental disasters, people would agree. There are some incidents of like tax evasion or tax avoidance where not everyone agrees. Especially finance academics don't always agree that aggressive tax avoidance is a negative ESG incident. And so we haven't done this, but what we are planning to do is basically produce our results by event type. If there is a good measure that captures how much people disagree on these, we might actually correlate with that. But my take would be that the events that are univocally negative will be the ones that are driving our results. Yeah. That's actually something we can look at, I think.
So, Sujit Kapadia from the ECB. So thanks very much. Really nice presentation and paper. So I just wondered how you control for information in the sense that you probably pay more attention to domestic news than foreign news, and even your patriotism measure. I mean, you could say that in more patriotic countries, people pay more attention to the domestic news than. And I just wondered, say, for example, that could explain a lot of the results. And would it be any different if I looked at, say, macroeconomic shocks? So is a macroeconomic shock in Norway going to have a stronger impact than a macroeconomic shock in Brazil? I mean, it strikes me that could be entirely explaining the story here.
Absolutely. So for the main result, I absolutely agree. Information could very clearly drive these less negative returns for foreign events. So this is why we actually jump into the cross-section, where we try to figure out what drives like more negative foreign returns after controlling for as many things as we possibly can. So actually these results that are here called foreign incident returns differ by these results. They are driven on, they are there after throwing in event fixed effects. So several firms might cause the same event, but they are also there after throwing in firm fixed effects. So firms repeatedly polluting the environment in different places in the world. And so then I guess the story about information has to be one where people in patriotistic countries pay more attention to foreign events in certain types of countries. And so now I guess this information story, it gets really, really complicated. Another way we take care of this is there are like 80,000 events in rep risk, but these are only the high reach, high impact, highly covered events. And so we focus on those to begin with, trying to kick out events that are not well covered and therefore unlikely make it to the US, for instance. But yeah, the lingering concern is there. If you have better ideas on dealing with the information story, let us know.
Hi there. My name is Dan Rubino, and I have a social media platform which is basically devoted to ESG and CSR and SDGs and social impact. And getting to one of the prior, getting to some of the comments of the prior speaker, I've done M&A deals now for the last 30, 35 years, and what I see now, and this is more of an observation, it's information overload. Information is coming from every part of the world, all government agencies, and it's hard to, put it all together in terms of standards and, what do companies do in terms of abiding by, whatever standards that are outlined. So, even with the ESG, it's almost impossible to actually crystallize and to, develop a pathway for companies. And I fear that, with all the information, and this is great information, that it's almost, it makes people, it's paralysis is setting in, and they just really can't see the forest for the trees. And you have this perfect incident, I think, ESG incident of the last week and a half, and that is the whole situation in the crypto field and what happened with FTX and everything else, because to me, that's a perfect example of ESG, and it's an incident, and it's a really, really big incident, and we haven't seen 10% of the ultimate fallout. So how do you sort of look at those sort of macro issues when you do your analysis and when you do your studies, and how would you look at it on an applied basis so that we could all look at these kinds of issues and deal with them appropriately?
So the short answer is we don't, but this is actually a great idea to implement a test that does exactly that. So what people have done in finance is they've looked at investor attention around like sports events, things like that. Here, there might be a way to figure out how many events are happening to domestic firms in any given month. And my take would be when it's an overload, when a lot of other stuff is happening, then likely the response is more muted. One thing we have done is we have looked at returns during the financial crisis versus returns outside of the financial crisis. The results we found were that these results are not there, and like even incident returns are not very negative during the financial crisis. Now, this is not necessarily linked to information overload. This could have other, other reasons. But I think that's the type of analysis we might actually apply your idea to. So I think it's another thing that we might actually try to implement. I should say this is very early. It's a long paper, but it's very early stage. And so we are always looking for additional cross-sectional tests that tease out exactly these types of stories and ideas.
You know, if anyone has additional questions for Stefan, please go ahead. But I also want to open the floor for folks who have questions or our other panelists if they have.
Yeah. So I just had one more on this paper. I'm Karen Bodner from BNY Mellon, and I'm going to go a little more small picture on that than your very big picture comment. And it could be that you controlled for this and you was part of what you sort of elided as you didn't have as much time. Have you controlled for the concentration of capital? Because if you look, for example, at financials firms, so 53% of U.S. financials stock is held by U.S. companies, U.S. investors, and 53%, and 49% of Latin American financial companies' stock is held by U.S. investors because the concentration of capital is here. It's less so for Europe. So in Europe, it's 37%. But that home bias doesn't align directly with where the capital is concentrated and how it's allocated. And I was wondering if you looked at that.
Yes, we do a little bit of this in the tests that look at investors from the incident country. But there is actually a lot more that can be done. So this institutional ownership data, for instance, is just super rich in trying these ideas. We haven't done that, so it's on my list. It's on my list for Mochi.
May I? Sorry. Hi, I asked a question earlier, Alex, Oxford University. Again, on Stefan's paper, have you thought about the impact on cost of capital in the medium long term? And I'm referring to the cost of new issuance rather than impact on share prices in secondary markets, and on borrowing costs for new bond issuance. And then additionally, this might be covered in more of the detail of what you presented, but how are you thinking about time lags and persistence, and have you observed anything interesting across the various different specifications you've done? Thank you.
Yeah, so on the first one, we have not done that, but we could actually, since we have all the data. On the second comment, so we have ruled out that investors predict these events. So there are no results the month prior to the incident happening. And we've also ruled out that there's something like a late response or a reversal or anything along those lines. So it really seems to be, on average, reasonably clean events that just happen, and investors respond to them. We are cheating here a little bit because the events, they occur on some day, on any day of the week, of the month, and we look at monthly returns. So we are not really trying to nail down when exactly they happen to see whether investors respond immediately or take their time. But that's something the data unfortunately doesn't allow us to do. I mean, to dive deeper into day-by-day returns.
Hi, Brian Burton, Burton Capital Ventures, independent law firm. I operate out of Charlotte, North Carolina. Curious to know if your research looks at type of ESG events and how investors may care versus environmental, social, like human rights issues or FTX governance issues.
Yeah, so they respond more strongly to environmental incidents, which might actually have to do with the earlier point. These are clear-cut negative events. They are less pronounced among the governance incidents. And we can actually, again, go much, much deeper because the data doesn't just distinguish between E, S, and G. It goes much, much deeper. Don't forget there are other papers in the session. Want to get off the spot. Okay, take a note.
I'm loving all these questions, though.
Thank you. Scott Cal, Responsible Asset Allocator Initiative. We work with large asset owners on deploying their capital responsibly and sustainably. So first question for you, Stefan, is where'd you get those socks? They kind of match with our moderator there. You should trade them, I think. My question was for Dragan. your study kind of concerns me. It sort of seems to indicate that, we know the world needs to move forward on dealing with this issue of climate change, but your conclusions seem to indicate that regulations are bad for business, and therefore let's not. We should. That's a good excuse for many not to go down that path. So I'm a little concerned, and also I'm not sure it makes a lot of sense that there are certain jurisdictions, and let's say in Europe. It's not a choice, right? There isn't any discussion about climate change or following certain kinds of pathways. Our choice of this is going to it's better for profits, it's worse for profits. It's kind of like doesn't matter. They have to they're required to go down that path. So as we move forward with this is not a choice. Doesn't that kind of focus take us in the wrong direction? The other thing is that it would seem to me that the greater concern would be correlating with uncertainty of regulation, not certainty. So if regulations, they're uncertain, we don't know what's going on, that would be a dampener potentially on people moving forward because they don't know what risks they're facing. But if they know what risks they're facing, one of the things we need to do also is invest in transition risk, right? We need to invest in companies that are, let's say, dirtier and help them to become cleaner. So how do you deal with all of those things in your work?
Great. Well,
I like your socks too, so.
Well, these are pretty generic from Costco. About the last statement that I made at the end of my presentation about the potential unintended consequences, all we're trying to do here is to highlight one potential downside of climate law regulation. I am not against climate laws and regulations, but as with all regulations, there are costs to consider. And whether to a certain country, the curtailment of international capital inflow is important or not, I think that's something that each country needs to consider on an individual basis. So that's all we're trying to do in there. The second, in response to your second question about what's your second question? I think
uncertainty versus.
Well, that's the third question about the uncertainty. I actually share the same feeling as you. That is, yes, I think passing a climate law regulation is one step. It can be one step, toward resolving that uncertainty, but also potentially can increase the uncertainty about exactly what follow-up climate-related laws regulation will pass and how stringent these laws and regulations will be enforced. So there's a little bit of ambiguity there regarding how much and to what extent the policy uncertainty will be resolved. So that's part of the reason that we think why we didn't find support for our second part of the main hypothesis, that is the passage of climate laws can actually unleash the appetite of cross-border acquirers to go after targets in these countries.
We have some other questions.
I'll try to think of the second question because I do have.
It's those three-part questions. It's like impossible to answer.
You got the sock question right.
Right. Yes, that was the best part. I don't want to skip anybody out here, and also I can't see. Okay. Well, you know what? I'm going to take a moment of moderators. Oh, got a question? Yes, please. Thank you for saving me.
Yeah, thank you very much for the great presentations. Just to build on Adam Keeney from the Office of the Superintendent of Financial Institutions in Canada. And just to build on the gentleman's question, Maybe another interpretation of the findings in your study is that, there's, some advantages to harmonization of regulation and laws across jurisdictions. And just, through the process of your research, did you gain any insights into maybe, low-hanging fruit in terms of, how to, achieve, greater alignment across different jurisdictions?
So I think, in one of the earlier presentations that I give, there's one implication I put on the slides. That is, we need countries to operate in a unified front, basically, passing climate regulations uniformly, because that will stop, cross-border acquirers from cherry picking. Okay, which country that we're gonna, put our acquisition dollars in. But then the response I got is that, okay, you can also wish for world peace. So that's why that implication is not, on the slides anymore, because I thought that's too wishy-washy. But I agree with you. I think in response to an earlier question about what Europe is trying to do by tracking carbon footprint of companies across border, I think that will do actually a lot in stopping the regulatory arbitrage that a lot of the multinational companies or cross-border acquirers are currently engaging in.
Well, what I want to ask all three of you as we're wrapping up in our last 5 minutes, as you heard each other's presentations, this is going to be a fun question. What from their work do you think you might incorporate in yours, like Atreya, your analysis of temperature and how we can price risk based on that? For you, Fei, with the cross-border analysis, and for you, Stefan, the home advantage, disadvantage, because there is a connection between all of your work, but I'll start with you, Atreya, because you've had the least amount of time to talk in all of this.
No problem. I thought, Stefan, your presentation about these international kind of links and you finding a specific significant negative premium on environmental shocks, especially globally, I think that could be quite an interesting expansion of this work, looking at temperature volatility, because we academics typically just look at the U.S. a lot of the time. I think it's very easy to forget about what other countries are experiencing in temperature volatility and temperature increases, which will be much worse in other countries. So I think it would be a great idea to use that type of rep risk data and maybe dig into it a bit more, looking at these sudden increases in temperature for firms that are across borders.
Can I follow up on that? Because
absolutely.
When and if you have produced the data on the temperature variation, temperature changes across the world, in different countries, I would like to actually use that as a proxy for how much a country actually cares about or has been impacted by climate change or global warming. And this will be neatly tied to one of the cross-sectional analysis that we currently have in our paper, that is, the acquirers coming from countries that have recently experienced the climate disasters or have shown a high concern for climate risk actually are not as deterred by the target country's climate law. So that temperature variability and temperature change can be something that we use as a potential measure for that.
I'll let you know.
We're replacing Twitter right here. See it coming together. Just have to do it one-on-one. But Stefan, sure, please.
Yeah, I think in Fei's case, I would be super interested in the time series of the climate laws that have been passed, because that might actually be another cross-sectional characteristic to interact with the foreign returns. If these laws exist, then monetary fines are probably more likely, and so returns might actually turn more negative for foreign events. For Atreya, I have an idea actually for an unrelated project on farming subsidies and their impact on farming productivity, where the TD-VAR measure, I think, will be just a the number one right-hand side variable to play with. So yeah, lots of insights. These are dangerous questions, though.
That's what I'm here for.
You need to listen.
Oh, well, this has really been wonderful. And Nathan, you didn't even have to give me the 5-minute signal. So I want to thank each of our panelists for their really insightful research. And I'm already feeling something awesome coming from the three of you and extending this work even further. You've definitely deepened, enriched our understandings of climate risk, climate-related financial risk, and I hope that everyone has taken something away from this that you can use in your work as well. And again, please give a round of applause for our wonderful panelists.